Even if you're a minimum wage employee, you can set aside $200 every month, and those $200 can change your life. Okay, let's kick things off. Are you thinking about your future? Maybe retirement? A down payment on a house? It's a big question, right? Fidelity is a name you've probably heard. They offer many ways to invest, lots of choices. So, here's the big question for today. What if you put $200 into some Fidelity funds every month? We're going to explore that. We'll look at the possibilities. Now, some people say investing is only for the rich. But is that really true? I'd say, not really. Chapter 1: The Power of $200 per Month, Consistency and Compounding. Alright, so why $200? Well, it's a number that's doable for many people. It's not a huge, scary amount. Think about it. Small amounts regularly. This is called dollar cost averaging. You invest consistently. You buy when the market is up and when it's down. This can smooth things out. And then there is compounding. This is where things get really interesting. Your money makes money. Then that money makes even more money. Over time, it grows. It snowballs. For example, investing consistently in something like the S&P 500 shows this. Even small amounts can add up to big returns over many years. It's like planting a tiny seed that grows into a giant tree. And some people still underestimate this. So $200 a month isn't just $200. It's a seed that can grow. Chapter 2: Unveiling Potential, Carefully Selected Fidelity Funds and Their Projected Growth. Okay, so let's talk about specific Fidelity funds. Where could that $200 go? First, think about growth. Some funds aim for big gains by investing in companies expected to grow rapidly. These funds seek companies with high growth potential, like emerging technology or innovative healthcare firms. Fund managers analyze factors like revenue growth and earnings potential to identify promising companies. FDGRX has shown impressive past growth, turning $100,000 into $6.6 million. While past results don't guarantee future performance, it illustrates the potential of growth-oriented assets. Consistent investment in such funds can yield substantial returns over time, as growth stocks tend to outperform in the long run. These funds target businesses with innovative products, expanding markets, and a competitive edge, which often involves higher risk but also greater potential rewards. Next up, dividends. Some funds provide income by investing in companies that distribute earnings as dividends. This is attractive to investors seeking regular cash flow. FNARX is one example, with a growing dividend that can offset inflation. Reinvesting these dividends boosts returns over time, creating a snowball effect. Consistent contributions, combined with reinvestment, can lead to significant wealth accumulation. Then there are broad market funds, like those tracking the S&P 500. Fidelity offers similar funds, providing diversification across many companies and reducing risk. Diversification is a fundamental investment principle that protects portfolios from the volatility of single investments. And you know what's even better? Some Fidelity funds have super low, even zero fees. FZROX is one such fund. Zero fees mean more of your returns remain with you. Fees significantly impact long-term performance, and zero fees are a big advantage. These funds offer different investment strategies for various financial goals, including high growth, steady income, and broad market exposure. Chapter 3: Building a Potential Portfolio Strategy with $200 per month. So, how do you put this all together? How do you build a strategy? Let's talk about a possible plan for that $200 a month. Remember, this is just one example. Your situation might be different. You could split it up. For example, consider these allocations, keeping in mind the long-term growth potential and historical data from the files. You might allocate $80 to a growth-oriented fund like FDGRX. Given FDGRX's past performance, turning a $100,000 investment into $6.6 million, consistent contributions could translate to substantial long-term growth, though past performance is not indicative of future results. This growth potential is driven by the fund's focus on companies with high earnings growth, which can lead to significant capital appreciation over time. However, it's important to remember that growth stocks can be more volatile than the broader market, and their performance can be influenced by factors such as technological advancements, economic conditions, and changes in investor sentiment. Therefore, this allocation is suitable for investors with a higher risk tolerance and a long-term investment horizon. Then, put $70 into a dividend fund, such as FNARX. FNARX has shown a solid 3% dividend yield, with an average dividend growth of around 11.35% over the past 10 years. This combination of yield and growth can provide a steady stream of income while also allowing for capital appreciation. Reinvesting dividends can significantly boost returns, as shown in one example. A $10,000 investment in a similar fund with reinvestment grew to over $730,000 in 30 years, with the majority of that coming from reinvested dividends. This highlights the power of compounding, where not only the initial investment grow, but the reinvested dividends also generate returns, leading to exponential growth over time. A consistent $70 monthly investment would add to this growth, further accelerating the compounding process and increasing the potential for long-term wealth accumulation. Finally, allocate $50 to a broad market fund. Investing consistently in an S&P 500, for example, has historically yielded significant returns over the long term. The S&P 500 represents a diversified basket of 500 of the largest U.S. companies, providing broad exposure to the overall U.S. economy. This diversification helps to reduce risk, as the performance of any single company has a limited impact on the overall fund's performance. While the returns of the S&P 500 can vary from year to year, its long-term performance has been strong, making it a suitable core holding for many long-term investors. The key is to stay consistent. Invest regularly through market ups and downs. As one file says, the strategy is about commitment. This means sticking to your investment plan even when the market experiences volatility, which is a normal part of investing. Trying to time the market can be detrimental to long-term returns, as it's difficult to predict market movements consistently. Also, if you can, consider holding these investments in tax-advantaged accounts, like a Roth IRA or a 401k. This could potentially save you thousands in taxes over the years, significantly boosting your long-term returns. Contributions to these accounts may be tax-deductible, and earnings within the account grow tax-free. In the case of a Roth account, withdrawals in retirement are also tax-free, providing a significant advantage over the long term. This isn't about getting rich quick. It's about building wealth, slowly and steadily. Like building a house, brick by brick. Each consistent contribution is like adding another brick, gradually building a solid foundation for your financial future. Chapter 4. Practical Steps and Important Considerations. Okay, so what are the next steps? What do you need to think about? First, you'll need to open a Fidelity account. You can easily do this on their website, fidelity.com, or through their mobile app. Then set up automatic transfers. This is key and it's simple. You can link your bank account and schedule recurring monthly transfers, so you don't even have to think about it. Also, remember to reinvest dividends. This is crucial for maximizing your returns. Make sure this option is selected in your Fidelity account settings. Keep in mind that this is a long-term plan. Don't expect huge returns overnight, and be prepared for market fluctuations. There will be periods of gains and periods of losses. It's crucial to understand that all investments involve risk. Past performance doesn't guarantee future results. You could lose some or all of your initial investment. Finally, do your own thorough research and strongly consider talking to a qualified financial advisor. They can help you understand your risk tolerance and create a personalized plan that fits your specific financial goals and circumstances. So let's wrap things up. Investing $200 a month in Fidelity funds can be a smart move. It's about being consistent. It's about letting your money grow over time. And it's about choosing the right funds for your goals. We've talked about growth funds. We've talked about dividend funds. And we've talked about broad market funds. Each plays a different role in a well-rounded portfolio. Now, we want to hear from you. Which Fidelity fund are you most interested in? Is it the growth potential of FDGRX, the steady income of FNARX, or the broad diversification of an S&P 500 fund? Let us know in the comments below. Also, please like this video and subscribe to our channel. And share this with anyone who wants to build their financial future. Start investing today and take control of your financial future.